it's hard to know where the markets are going, but the one thing I think we can say is they are turbulent. In these turbulent times, where do you put your bucks at this point? Where does it make sense?
Well, look, you're not going to be able to put your money anywhere that is going to be unaffected by the volatility. So if the objective is find some place to invest where you don't have volatility, that's the zero-sum game. On the other hand, equities will go up over time and credit has gotten a lot cheaper. And so if you're looking for incremental places to invest, even large institutional investors, you have to be beginning to look at putting some money back into the equity markets. They're down 30+%, and some money into the fixed income markets because spreads have moved out pretty dramatically. But you're not going to be able to do that without volatility, and you're not going to be able to do that without additional drawdowns. So you need to be cautious about how much you commit.
Well, and Gillian, I wonder if you're going to be able to do that without additional risk. I mean, Peter says that credit is cheaper now. It's a better buy. You can get better returns. There may be a reason for that. What is the risk of defaults? We haven't had defaults in a while now.
Well, we're going incredibly retro in all kinds of ways right now. You haven't yet got the sideburns, unfortunately, David, but I hope we see that soon of your former host. But, you know, one of the things that investors have not had to worry about for a very long time are corporate defaults and risks in the high yield market. We're still not seeing that. The default rate right now is incredibly low, in spite of all the falls in the equity market and concern about recession. But what you're seeing a number of bankers and lawyers and others talk about is the likelihood that as rates keep going up, we're going to start to see more and more pressure on risky companies. Now, it's hard to predict exactly when that is going to strike because most risky companies, most high yield companies or leverage loans have been essentially refinancing themselves or have locked in financing for quite a while. So it will really only begin to bite when the refinancings come up. And that's a sort of staggered timetable because each company is different. But when you do see those refinancing occurs, you could see a very nasty shock for investors. And you're already seeing the high yield bond market react to that. In fact, in some ways, that's the clearest part of the markets where you've actually seen a reaction to the tightening of liquidity conditions. So that is absolutely something that investors should be looking to in the next year or so as one of the big risks that are awaiting us all.
Peter, I wonder if we're getting an accurate read on the full market right now in this sense. But back in 1975, by the way, I was just starting law school. I did have sideburns, for the record. They weren't quite as white, but I did have them. But one difference is...
You can bring them back, David.
Yeah, exactly. I'll try to bring them back. They'd be a lot whiter now. But Peter, I wonder, one of the changes that we've seen since 1975 is how much the markets are private rather than public. We've seen a big shift. And I wonder whether we really are getting an accurate read on all that private capital.
No, we are not. By the way, I never had good sideburns, so that's why I went with a beard. But with regards to the private markets, I think that is a serious problem, meaning that we know for a fact that private markets lag public market valuations. But it's also a fact that the assets owned in private hands are also being affected by this market change. You cannot have this change in the interest rate construct that I spoke about briefly before without affecting values. So private equity assets are going to decline in value. I've already gone down in value, but haven't yet been adjusted. And those adjustments, when they occur, are going to cause stress for investors. In some cases, they could cause liquidity issues. In some cases, they may actually make raising additional capital much more challenging. And in some cases, they could cause defaults and ultimate bankruptcies. So that whole private credit and private equity sector is a place where we need to be focused on risk rising substantially and potential stress coming from a mark-to-market of those assets.
Gillian, these days we can't have a real conversation about investing without talking about China in one way or another. Of course, we have the 25th anniversary of the handover of Hong Kong right now going on with President Xi in Hong Kong. Is China a place that's attractive potentially for investors? Because they're going the other direction from the United States and much of the West. We're tightening, they're actually loosening.
Well, absolutely. China is something of an enigma in many ways because, yes, they are going the opposite direction from most other markets right now in terms of loosening. There is great pressure on President Xi to ensure that he tries to hit the GDP growth targets because he has the all-important Party Congress later on this year. And all the signs are that because of the COVID lockdowns, they're in danger of missing the growth targets. So President Xi has every incentive to try and stimulate the economy going forward in the coming months. The problem, though, really is two or threefold. Firstly, we don't know how China will respond if there are more COVID outbreaks. The lockdowns in Shanghai have been very damaging, but thus far, there's no sign that the government's going to back away from those if there are more COVID outbreaks. So that could certainly upset the economic figures. And of course, China is exposed to the wider global economy as well. So yes, China could be providing some growth for the global economy going forward and offsetting some of the problems in Europe and the US. But the one thing that's clear is we cannot expect China to do what it did back in 2008, which is to provide a real motor for global economic growth that drags the other countries out of a potential recession.
Peter, what about it? You've had a career now investing your money and other people's money. Is that a place where you should be putting money right now, into China?
Can't be short China right now. Just can't. Being long China is a challenge for sure, but being short, I think, is a very big risk. Look, I also think investors are somewhat circumspect about the motivations of the government with regards to the external investor. How will they treat the bond investors? How are they going to treat equity investors vis-a-vis regulation and changes to companies inside of China that were thought early to be leaders and real growers? Those issues still remain. But China's a huge market, very strong economy when it starts to grow. It will come back. COVID will get resolved. And China still provides significant exports to the world and buys significant imports. So I think as an investor, it's very, very challenging to be short China. And I wouldn't be.
Okay, let's give the last minute here to the European amongst us. Gillian, what about Europe? What kind of shape is Europe in?
Well, Europe, as ever, is a varied mix. You've got some places like the UK, which look really pretty soggy right now, to use a wonderful British phrase. You've got other parts of Europe that are doing better. But the one thing everyone needs to realize is that Europe is very vulnerable to any retaliation or any more retaliation on the energy front as a result of Russia's invasion of Ukraine. So Europe, as ever, is unlikely to go completely off a cliff, but is unlikely to boom. And so there's growing concern right now about the price pressures building. And, that isn't a very safe haven either. I guess the real message from all of this is that right now we're not dealing with a beauty parade in terms of decisions about where to put your money. It's really more like an ugly parade, which is a least ugly place. And probably the only best option out of all that is a classic investment advice of diversify, hold your breath, and look to the long term.